In this video, we'll be looking at closing entries for a perpetual system of inventory. Let's take a look at an example. This is example 5-4, which will continue on from example 5-3. So there's a link in this spreadsheet if you'd like to click back and see what 5-3 was all about. Otherwise, now's a good time to pause the video, download the spreadsheet, and try these questions out. If you've already had time to do that, let's get right to it. Required 1 is to complete the income statement. Down here, I've copied and pasted the income statement that we completed in example 5-3. You can see here we started off with sales revenue, subtracted the contra revenue accounts, and arrived at net sales revenue. From that, we subtract the cost of goods sold and arrive at gross profit. All that's left to do is subtract the operating expenses. In this example, earlier on, it states the operating expenses are to be assumed to be $725. What I've done there is I've just taken all of our other operating expenses and have collapsed them into a single line item. So what's in operating expenses? Things like amortization, rent, insurance, salaries and wages, utilities, etc., etc. After we subtract the operating expenses, if we have a positive number, which we do, we have our income from operations, or in this case, we would just call it net income. Don't forget to double underline net income, please. Moving on to required 2, we are asked to close the accounts by recording the appropriate closing entries. Assume no withdrawals were made during the period. Different textbooks will approach the closing of accounts in different ways. Some textbooks will recommend that you close all of the temporary credit accounts first, and then all of the temporary debit accounts next. They find that easier and simpler to do. In my experience, students have preferred to first close all of the revenue accounts and then close all of the expense accounts. So we can try to do it that way for this question. Closing the revenue accounts would look as follows. We would close sales revenue, which is a normal credit balance. That is closed with a debit, $3,500. Sales discounts, sales returns and allowances. These accounts are normal debit balances, so they are closed with a credit. That leaves a difference between $3,500, $59, and $550, a difference of $2,891 that's needed to balance this entry. That amount goes to income summary. This amount should look familiar to you. If you bear with me, I'll scroll back up. And you can see net sales revenue is $2,891. So that's what we see here. You would expect, if we close the revenue accounts first, in its own step, to see net sales revenue in income summary. We can take a look at income summary and see that the only thing in there right now is net sales revenue of $2,891. Moving on, we can close the expense accounts. We have here only 2 expense accounts. We have the cost of goods sold, $1,776, and operating expenses of $725. That totals $2,501 that is closed to income summary. If we are to update income summary, we see net sales revenue inside income summary and the total expenses. The difference is $390. That should look familiar to you. Again, if you'll allow me to scroll up to the income statement, you'll see net income of $390. And that's what we expect to see after all revenue and expense accounts are closed. We would expect to see net income or loss sitting inside of income summary. Finally, it's time to close income summary to owner's capital. I've written here, I've just made up the name of an owner, K. Smith. So we'll close capital to K. Smith Capital. So income summary is debited for $390, and we credit K. Smith comma capital for $390. Taking a look at income summary is now closed. In our next video, we'll turn our attention to a periodic system of inventory. So see you then. Thanks for watching.